Welcome to our latest webinar for corporates. In this series, we'll be examining recent events and looking ahead at what might be in store for financial markets and the economy. Good morning, everybody, and welcome to the February FX market update. The webinars that we've been hosting have proven very popular, and I expect that this will be no different. I'm going to do things slightly differently today in terms of I'm actually presenting second. Piers will be presenting first. So we're doing it in reverse order, but that's because Piers is going to give you an update on what his thoughts for the year ahead are after we've had all of the close. He did mention this on the January call, so I hope that's not too much of a surprise. Then I'll do a very brief sort of assessment of where we see things. Over to you.
Hi, thanks very much, Neil. So today is going to be a time where I'll look more for the outlook for the year. We'll look at the yearly charts mainly, and hopefully this will let us see where the long-term support and resistance areas are located. Because it's always good to remember where those big picture levels are, especially if we look at the daily and weekly all the time. But sometimes you need to know, when are we going to see a turnaround? Can we get ready for it ahead of that time? We must also remember that anything we know and we expect to happen is already in the price. And we know that because if something is expected and then it doesn't turn out to be as expected, the market reprices very quickly and moves to a new area. And we saw that last year a lot on interest rates and inflation numbers. And we'll probably see that again this year. And especially over the next few days, we've got central banks today, tomorrow. And so you'll see those events today. And I think that will move the markets. But one thing that is not priced in at this stage is the shock event. And I try and say this every year. It's the shock event that blindsides you, that no one's talking about. That's the thing that catches markets. Normally they sort of go along and people know roughly where they're going to go. So remember these levels I'm going to give you, they're the long-term levels, but also remember for that shock or jolt, because money normally moves into the dollar if you get that. And it seems to be we get those events much more often now, much more regularly. I mean, the first sort of 10, 20 years I worked in FX markets, it's once every 10 years or something got this real big shock. But now it just seems every year. I mean, sometimes they're quick and sometimes they sort of build up slowly. I mean, if we remember back a few years ago, before COVID happened, we saw it in Asia and it was sort of coming round. And it took some time before suddenly you got the big toilet roll panic and COVID lockdown. That took a bit of time. And last year there was all talk of build up for about a month before the Ukraine-Russia war started. So some of these events will slowly come through, but some are shocks. And it's those shocks you have to be ready for. So with that, we'll go on and look at some of the charts. So the first chart we're going to look at is the dollar index yearly candle. And what we can see nice and clearly on the yearly candle is that price went down and prices moved up. But last year saw it move from the 23.6% at the bottom, try breaking the 38.2%, but that's strong to 38.2%. And price came back down to close below that and also the top Bollinger Band. So that shows that the market's not quite ready to go into that next bout of strength. Because if you break the 38.2%, you should be looking for 61.8%, I feel. But the market's not ready. It's not that strong to go up for that area at this stage. So we now know where resistance is located. It's at that 109 area. So that's the area price needs to get back and hold above if we're going to see another bout of dollar strength. For more dollar strength, longer term picture, you need to see it holding above 109. Well, if it got back below the 95 area on that chart, on the yearly chart, then that would be a bit of a cause for concern, because where has all the strength from last year gone? So on the yearly chart and during the year, we should watch 95 and 109. But we can't wait till the end of the year just to see what happens there. We have to sort of see a bit more what happens during the year. So if we go to the next slide, this is the quarterly candle chart, which I put on last month's webinar, where we had the down trend line in pink with the 4 touches. Then it broke above it last year and rushed up. So now at the moment, you can see you're in retrace mode back down to where it broke out. So that's going to be important. Where does this market find support? So there's two areas on the quarterly chart we need to watch as the year progresses. And the first one is 98 to 101. So that 98 to 101 area is the 38.2% retracement of the 2008 to 2022 rally. And we sort of want to see that 98-101 area hold. Now, if it impulsively holds there and goes up, we're going to start looking at the sort of 106-109 area. Can it get up there, or is it going to go up, fail, come off? So it's something we're going to have to watch as the year goes along on these quarterly charts and just see how each quarter goes. But at the moment, I think sort of 98-101 should provide some support. If it broke there on the quarterly chart, the next strong support area there is 87.92. And you might think, well, he just said 95, but that's the yearly chart. So within the yearly chart, you could go down to 87.92 and then find support and bounce back up. But it's if that 87.92 area breaks on the quarterly chart, then it's game over for the dollar. And it's had its run, no one's interested anymore. But at this stage, I'd expect moves lower, especially move lower back towards the Ichimoku cloud or the old trend line to get bought into. And then I'd watch how impulsive, how strong is that bounce. Because back above 109, 110 definitely brings back long-term dollar strength. So the next slide we're going to look at is euro dollar. So this is the euro dollar yearly chart. And again, what can we see here? We can see a few clear things just looking at the basic levels here. So we can see that it rallied all the way up. It fell down towards the 38.2% retracement, which I've put the 38.2% underneath it there. You can see that held for a few years. Then it broke below the 38.2% retracement, breaking the uptrend, rallied back up towards that uptrend, kept failing, tried again 2 years ago, failed at the 38.2, and then where did it go? 38.2, you normally go 61.8%. And that's exactly what happened last year. It went down to that 61.8% at the sort of 96 area. So it bounced impulsively off there and closed around the 50%. So you're mid its range at the moment. And that tells us that if we're going to move out of this move, to get positive, you need to be above that top line. And that's 120, the 38.2%. It's also the 20-period moving average from the mid-Bollinger. So I see that as resistance. So that's going to be a tough area if it does get up there, get towards that. That's even if it gets there, but that's going to be the real tough area. We know where the support is on the downside. It's 0.96, 0.97 area. And that's the area, if broken, could suddenly lead to a move down towards 0.90, 0.91. So those are the key levels to watch from a yearly chart perspective. But as we say, we've got to do stuff during the year, and we can't just wait to the end of the year. But at the moment, what does this also show us? It shows us that we're making lower lows and lower highs since the sort of 2008 financial crisis. So it's still making lower lows. But the spike on the bottom of last year's candle does suggest that the market saw good reasons to buy it down there. So we go to the next slide and try and zoom in. What are we doing more and more around here? We can see the extensions going down. So again, look, that 38.2% of the extension held on a quarterly on the yearly close last year. So that's around the 104.25 area. And if that breaks, that 104.25 area is where you'd like to see break to start a move down towards 96, 97, potentially 90. And again, on the top side, I think there should be a resistance around about 111, 112 initially. But if we go to the next slide here, here's the quarterly chart. So that gives us a bit more detail within those moves. So we can see here, it rallied off the 95 area, but there was a trend line that broke from 2000, the pink trend line going up. So as price moves up towards that, it gets also the first retracement just underneath 111. And then you've got that old trend line. So that's where it's going to start to feel the pain and start to suffer in the 110.75 area, 111. That's where it's going to, I think, first find resistance. But if it gets above there and starts to do a strong move up, look what's above that. At 120, that 120 area again, it's the 38.2% of the move down. You've also got the Ichimoku cloud, and I've highlighted in the two circles there that going back a few years, if you look at 2018, 2020, and 2021, all those dollar moves, euro dollar moves higher, were capped by the cloud. So that 120 really is a tough area. And that still makes me think that although we might see euro dollar higher, I think the longer term risk is there'll still be potential selling if we go above 111, 112. If we go above that, there's risks that you could at some stage find selling come in. On the next slide we look at is the sterling index. This is the yearly chart, and it shows what's happening with sterling. If you look at the move down, it's been a dramatic move down. And you'll see that sterling has nearly halved in value since 1980. It's a really bad thing if you're like me and like to go on holidays. Not having strong sterling is very bad. But one thing in candles you look at is the size and colour of the candles. And the two candles that stand out recently to me are both red and negative, and I've highlighted them on that chart. And you can see that for the last second red negative candle, which is 2016, price in the 6 years after that hasn't managed to take back 50% of that move. And it's sort of just edging up sideways, sideways, sideways. So it could be building into some sort of potential flag for a move even lower. And the one thing maybe saving it is the spike on last year's candle. But where do we get positive? So at the moment, to me, that chart looks negative. It makes me think sterling goes lower overall, big picture. But is it going to rally before it goes back lower? Well, for that, we want to look at the next slide. And I won't bore you too much on this slide because I've put this slide out every webinar, every breakfast seminar I've done since Brexit. Look at the 38.2% retracement. It's just held all the way across. So I think there's been 12 quarters where it's managed to get up there and fail there. And it's stopped me getting excited when lots of other people have got excited about sterling after an election, after this, after that. They're always very excited on sterling. To get positive on sterling, you just need to see a quarterly close above that 38.2%. So that's where the negative risk goes, basically. If it gets below that blue dashed line on a close, that's not a very good thing. And that will put more risk on the downside. But at the moment, it is trying to struggle higher, but I think there's a risk it could fall back down. So if we go to the next slide here, we've got sterling dollar. And on this sterling dollar chart, I've put on the Bollinger Bands and the retracements of the move lower. Now, if we take that low to high, and I'm ignoring that spike down last year, I'm keeping the low as the low when it first had proper trading. I mean, last year was a flash crash. So I don't like that. So I'm keeping it on the old one. You can see that that first retracement comes in also with the mid Bollinger, the 20 moving average from the Bollinger Bands. So that's around the 137 area. So yes, you might get a rally up, but unless you get above 137, sterling runs the risk of just going up and falling lower again. So that's the big picture. The good news, though, if you want sterling dollar higher, is look at that trend line. I did this trend line last year at the start of the year. You had 3 touches. You've now got 4 touches because it went below it last year, but came back to close above it. So that's a glimmer of hope. But it's only a small glimmer of hope because I think the rally up has a lot to contend with looking at the previous price action. If we go to the next slide, this is it on the weekly chart. So I've tried to zoom in a bit to give a bit more speed rather than wait for the year and see how it all looks. We can see that on the retracements, we broke the 38.2%. The market went back down, found that as support in the sort of the 118 area, rallied off it quite nicely, and is going higher. But what's capped it for the last 3 weeks is that Ichimoku cloud. You then also have the lagging line, which is way away from the cloud. And to be positive cable, from a medium-term view, you'd need it above the cloud with price, lagging line and price above the cloud. But at this stage, I sort of think that rallies, it looks like, will struggle in the 127.5, 133.25 area, being the 61.8 and 76.4% retracements. Support should be at that 119.50, 120 area initially, and 116.50 below that. Any weekly close below 116.50 would be the signal to me, actually, this has had its run higher. The bears are back in control. The sellers are taking it back and it's going lower. So those are the levels I put on it for the moment. But one quick slide I'm just going to quickly talk about is the next slide, which is the 8-year cycle. Every 8 years, sterling dollar seems to have a big collapse and a big down. And this is one of the things that helped in 2015. I started saying, okay, we'll go to 130. And then people told me I got lucky with Brexit. I don't think I got lucky with Brexit happening for that call. I think it was more this 8-year cycle. Every 8 years, something seems to happen that takes something down. So the only reason I mention it is because next year is 2024, is the 8-year. So I know there's an election next year. That might be it, or there might be some other shock. But just bear in mind that normally on an 8-year, it goes down. You know, who knows? Maybe it decided to go 1 year earlier, and this year was the move down. But it's just worth keeping in mind. That'll be in the slide pack when it comes out, and we'll keep talking about that as the year goes on. So the next slide we look at is euro sterling. So the euro start, the prices are synthetically done, and I've done the retracements from when the euro actually started. So you can see it's the 38.2% to the 23.6% levels holding again. Last year, we saw price bounce and hold the 38.2, go up to the 23.6 and still there. So what do we need? What do we know from that chart? We know that to see euro sterling as negative and going lower, you need to see price break and hold below that 38.2%, the 82.30 area. Also, the 20 period moving average is acting as support in the same area. So it's a very key area. What about the upside? Above 90 increases the risk that we could see 94.77 and potentially parity if 94.77 is broken. But I know a lot of you look sterling euro. So on the next slide, I've done sterling euro. Sterling euro, the retracements just don't work. Somehow technical analysis on sterling euro doesn't work. I think it's because euro sterling's traded, so they all work quite well. And this is just sort of a byproduct. But the level to watch here is 121.50. If you want sterling euro higher, you need sterling euro above that 121.50 and holding above that 21.50. But I mean, the other thing that strikes me about this chart is going back, sterling euro, the equivalent, was over 4. How cheap would holidays have been then? I mean, definitely the wrong time. It's a shame the chart's not the other way around. We're up at 4 now and used to be at 1. But 121.50 is the level to watch. If it gets above that, that's great. Where does the downside risk increase? Below 110, that could open 105.50, and below that, parity. And the final currency I'm looking at today is, on the next slide, dollar China. Neil always talks about China and mentions the rate, but it's important this year because China is reopening after years of COVID lockdown, and it will be pretty key to the year what happens in China. Will China take off? Because that would increase productivity around the world as people need stuff. But it also risks keeping inflation higher as more demand for oils and commodities kicks in and China starts wanting all those resources again. So are we going to get that? Or will this reopening backfire? Will it all stall and fall back down? That's going to be the story of the year, I think, one of the stories of the year. So looking at the dollar China rate, you can see that it bounced. It did the rally, came back to the 38.2, went back to the 23.6, went back down towards 38.2, and then last year tried to break the 23.6 but failed. And I think for a quicker guide on dollar China, you watch 638.50 as initial support, 725.50 as resistance. And if you get a breakout of there, I suggest some sort of move, longer term move is starting. And the last slide is just showing it on the quarterly chart on the Ichimoku cloud. Keep an eye on this as well. you can see that it shows in 2019, all the rallies were held by the Ichimoku cloud. It needs to get above the cloud with the lagging line to get positive. But it's testing up towards that. So I wouldn't rule out that at some stage it does try and break that cloud. But you could see it fall off the cloud, so keep an eye on it. And apologies, Neil, that's a bit longer. One other thing I say, these are financial markets, not door numbers. So these levels we're watching now can change very, very quickly. But there's the disclaimer as well, disclaims me of everything I've said. Neil, over to you.
Piers, thank you very much as ever. Fascinating stuff across a broad array of different currencies. And we'll certainly look forward to the updates throughout the year with regard to how things are changing, looking out for that catastrophic event that nobody's predicting as well. So I'm going to quickly move through the fundamental outlook and how that has changed. One big piece of information is the IMF's January update on their forecast for global growth. So we'll look at what they've done there. We'll look at how things are changing with regard to the central banks and what's predicted, what's priced in for the pace of tightening over the coming meetings. We'll look at where the pressure points are for global activity, one specifically that I think deserves highlighting before moving on to the forecasts that have changed a little bit. So I want to highlight some of those changes. And then again, I've got my disclaimer, which is equally as large and equally as disclaimy as Piers. So moving on and looking at growth and where growth is heading. Now, the IMF have upgraded their forecasts for 2023. Global growth expected to be a little bit stronger. Growth in the US, in Euroland, in a number of other economies expected to be stronger, but not in the UK. The UK's growth number expected to be weaker, considerably weaker as well. Look at that revision, a revision of 0.9 percentage points on 2023, taking us from a small increase in output to a fairly sizable reduction. Now, why would the IMF be seeing that? Well, I think there are fears over the effects of inflation and higher interest rates because the UK does appear to be more driven by short-term interest rates in terms of key sectors like consumption expenditure and also, of course, the housing market, both of which have appeared to be under pressure of late. Notably as well, a slightly slowing pace of economic activity in the likes of the US, a much slower pace of economic activity in Euroland, but no recession predicted, and slower growth as well for the likes of India, but a faster pace of growth for China. So worthwhile just pointing that out because that might mean a bit of a switch around in terms of where we see activity from an FX perspective could put a bit more additional pressure on the Indian rupee. So moving on to the next slide. And where we're seeing things as far as interest rates are concerned, well, looks as if the Federal Reserve will hike by only 25 basis points tonight. We think the Bank of England and the European Central Bank will both hike 50 basis points on Thursday. That said, these will appear to be different hikes because of the language used by both the Bank of England and the European Central Bank. So the European Central Bank probably going to be more wedded to additional aggressive tightening from here. The Bank of England less so. And as for the Federal Reserve, it is more about what they say rather than what they do at this meeting. So will they continue to signal that they're more worried about the labour market and its strengths than they are the weakness that we've seen across retail, the housing market, and also industrial production? The question is whether the assessment that we've seen from the IMF is accurate as far as the slowdown in economic activity is concerned, or whether actually we are yet to see the full effects of higher interest rates on economic activity, and that there will be a cumulative negative impact on the global economy, but particularly on the Western developed economies as we head through 2023 and into 2024. So the central banks might actually not only have to slow the pace of tightening, they might actually have to reverse course as we head into 2024 or even before that. So moving on to the next slide, and we look at, and I wanted to highlight this. This is retail sales. Now, one thing to highlight first and foremost on this is the US is a value-based series. The Euroland and the UK retail sales figures are volumes based. So the US looks better because it's had that boost from higher prices. But that also means that as prices reverse, as we see these headline rates of inflation falling back and potentially even in some areas of retail, prices turning negative once again, one would expect to see the US retail numbers underperform where we see the likes of the UK and also the Euroland retail sales figures. So it's just a bit of a trick of the data here that we're seeing with regards to the relative strength of the US consumer sector versus where we see the likes of the UK and Eurozone. That said, I think the consumer is the real pressure point here. There are increasing signs across all of these three jurisdictions that consumers are making more informed choices about trading down, so trading to more budget items, and that's really putting the thumb screws on the middle ground as far as retail is concerned. We have seen some additional dislocation within the retail sector, with one company going into administration yesterday in the UK. Expect that further pressure to have a real push to the downside in terms of consumer spending. And I was very intrigued by something that the British Retail Consortium said. They said that over the course of the December-January retail period, that any improvements that we were seeing as far as retailers were concerned was probably being bought with debt. And that increase in debt means that consumer demand is likely to fall away over the remainder of this first quarter and into the rest of the year. So just watch out for that buildup of consumer debt. Some of the weakness that we've seen in some of the consumer spending and credit figures lately may well be more telling about where we're heading over the course of the remainder of 2023. So what does all this mean for the currency markets and where the currency markets are heading? Well, this next slide is the updated view. Now, you'll see if you look at this versus what the view was back in for much of January, that the forecast view has changed a little bit. So stronger euro, stronger sterling against the US dollar. So a continuation of the weakness of the US dollar. Equally as well, a bit of a stronger yen against the US dollar. Overall, it's more of the same. It's dollar weakness that we're really predicting here rather than sterling or euro strength. But independently, we might get a little bit of euro strength if, as I believe, we're going to get what looks to be a hawkish hike from the European Central Bank, whereas we'll get a dovish hike from the Bank of England. So signaling fewer hikes to come from the UK than from the euro area. Piers has already mentioned it, but I think it's worthwhile flagging again in terms of the Chinese currency. We backed away from 7.3 and we're now trading comfortably in the sort of 6.7 region in dollar China. Does that pave the way for more support for the Chinese renminbi going forward? Well, if we're thinking that we're talking about a more negative overall dollar picture over the course of much of 2023, then the renminbi is likely to benefit a little bit. And I think this is more indicative of emerging markets making some headway against the losses that they accrued over the course of 2022, rather than this being independent strength for any of those emerging market currencies. But it could be a better year as far as emerging market currencies is concerned versus 2022, which was pretty dreadful all around. Now, this final slide, before I move on to the disclaimer, is just listing another thing that the research and strategy team are doing. So we're doing a podcast on a weekly basis called The Currency Exchange. It features the likes of Brian Dangerfield, Paul Robson, and there'll be a few special guests as well, just looking at how the currency markets are developing from a fundamental perspective. Thanks very much for listening to the webinar. We hope you found it informative. The next in the series will be available shortly.